take this discussion forward, we've got Arnab Das, Global Macro Strategist, EMEA at Invesco, joining in on the show right now. Arnab, hi, good afternoon. Good to have you on the show right now. Just wanted to understand all the hype and all eyes now on Jackson Hole. What's Powell going to say with regards to US economy, the latest jobs data? Does it seem like a September cut is inevitable, or are there still question marks around it?
I think a September cut is extremely likely. Maybe, never say never, so not quite inevitable. But I think, we've been moving in the direction of September cut for some time. Maybe the market has gotten ahead of itself in terms of the extent of the easing cycle. It had gotten ahead of itself a few times, I would say, in terms of when the easing would start, how deep the cuts would be, how fast and how thick they would come. But now I think we're more or less priced correctly for the very short term. And so I think we are on the cusp of an easing cycle, maybe not a very deep one, because I'm sort of in the camp that we're going to have a bumpy landing, not a full-blown soft landing, but nor are we going to have a hard landing and a severe recession. So we can talk more about that. But I do think, the message that's going to come across generally is data dependence, and yet signaling the start of a rate cutting cycle without strong commitments to the pace and the extent of easing.
Interesting. But Arnab, hi, this is Anisha also joining in the conversation. What about the recession fears? Do you think those were overdone when we were all talking about it just a couple of weeks ago?
I think so. Look, I think, people have been calling for this recession for ages, right? We've been waiting like Godot in terms of the rate cuts and the recession. I think part of the issue here is that many people are still trying to force fit a very unusual downturn and recovery and then disinflation into the normal cyclical template that we've all become used to over a period of decades. But this has been a very different cycle. It's had much more to do with the supply side than most of the cycles in people's living memory, right? And I think, that's still going on, right? A big part of the softening in the labor market that's been taking place is about labor supply. It's about an increase in the labor force participation rate. It's about an increase in immigration. It's about a widening gap between the household survey and the establishment survey, which send very different signals much of the time, but even stronger differences this time around. So, without wanting to be, too much in the camp of this time is different, I think there are important differences that bear, watching and keeping in mind as we look forward to what is clearly a slowdown, but is not yet clearly at all a recession, let alone a hard landing, in my view.
Okay, so not a recession or a hard landing, but what about India? Because that's managed to outperform quite strongly, whether you say in terms of growth. India is one of the fastest growing economies. Stock markets have been close to the record high levels as well. How's the global investor looking at India right now?
Look, I think there's still a good deal of optimism, that despite, many people hoping for a stronger majority for Modi and for the BJP in the election. I think there's still very much the sense that this is a good time, not just this year, but years to come and maybe decades to come for India for various reasons, right? The demographic dividend is still there, although it's not being fully exploited. The election sends a message that job creation and inequality have to be dealt with. Unemployment has to be dealt with. Underemployment has to be dealt with. So there are moves afoot in that direction. I think there's still the possibility very strongly out there that India becomes more of a manufacturing economy. There's no reason why India cannot be, right? Before the British Raj, India was the world's largest manufacturing and trading nation by quite some distance. So it can go back in that direction, but it needs to continue to liberalize, and particularly liberalize the labor market and liberalize the land market. And maybe continue to be somewhat difficult to do, but moves are obviously, as everybody knows better than I do, moves are afoot in that direction at the federal level and at various state levels. So I think the future for India looks brighter than it has been in a long time. I think the only issue for the international investor is how much that is in the price, because equities in India often tend to have very high valuations, and now they continue to have extremely high valuations. So that is a challenge. But I think many investors are continuing to hold on to India. Flows are continuing to come in, institutional flows. And so I think that's going to continue.
And I also want to talk about, the clear sort of bone of contention from where this global shake-off that we had last time actually started. Japan, that is. And do you expect the issues around yen carry trade to continue, and whether, both growth as well as the interest rate differentials are going to remain this way for the next foreseeable future?
Yeah, look, I think we had a tantrum in the markets, and I suppose the tantrum has a few different causes. One is the July non-farm payrolls number in the U.S. was unexpectedly weak, and the market apparently wasn't prepared for that, and it sort of coincided more or less with a more hawkish signal than expected from the BOJ governor Ueda, around the same time a couple of days before, and that I think set off a volatility shock that has kind of shaken out a lot of the carry trades. If you look at the data in the Chicago Mercantile Exchange on net open positions, FX positions in dollar yen, you see that those have come down quite substantially. So right now, it looks like a lot of the speculative part of the carry trade has been unwound. And maybe what remains is some speculative positions. Maybe some of those are being put back in, as well as more fundamentally driven long-term positions by Japanese retail, so-called Mrs. Watanabe, institutional investors in Japan, and corporates, which are investing in higher yielding because higher growing countries, not just because of the higher yield, unlike the speculative investor, who was really betting on currency stability and an interest rate differential, right? That's what's been shocked. Now, I think looking forward, the thing to do is to keep an eye on the situation, because the interest rate differential is likely to continue to narrow. In my view, it's going to continue to narrow from both sides, with BOJ gradually, slowly raising rates, and the Fed gradually, slowly cutting rates. Now, if either of those things changes because Japan is reflating faster than expected, or the US is slowing down faster than expected, so if I'm wrong and there's a harder landing coming in the US, for example, that might cause another bout of volatility. I think it'll be more limited than the last one, because the last one appears to have shaken out a lot of the speculative long dollar, short yen positions, and not just dollar, Mexican peso, Turkish lira, possibly even Indian rupee, right? Apparently the RBI had to intervene, or chose to intervene at that time. So I think a lot of that has been shaken out, but a lot of it, some of it may be coming back in, not least because Governor Ueda also indicated that during the shock and the turbulence that the BOJ would not be raising rates if market conditions were extremely volatile, which of course makes sense, but it does create a little bit of moral hazard that encourages speculative shorts in yen and longs in other higher yielding currencies to come back into play. So I would keep an eye on it, but I wouldn't expect another severe bout quite as bad as what we've had before.
Don't expect another bout of yen carry trade getting unwound. And just before we let you go, Arnab, what's the best tactical trade right now globally? Because you have the US dollar, which has slipped almost to that 100 level. You have the crude, which has been very volatile, around $75, $80. Gold continues to spike. US markets are doing well. What within all of this do you think is the best tactical trade right now?
Look, I think all of these things are going to continue to remain in play. I'm not sure I would put on a very strong tactical bet on either of these directions at the current moment, right? Because I think a lot of this is already priced in. So like I said, I'm of the view that there's a 25 basis point cut coming. That's more than priced. There's something like roughly 30, 32 or something basis points, right? So the cut in September is, if most of us who believe that's going to come, 25 basis points are correct, that's already priced in, right? So it's not going to do very much. I think what you have to do is look further out. And there, I think, we're going to have, like I said before, a slower, more gradual, more sort of data-dependent easing process. I think it's still going to lead to a weaker dollar. Higher gold price is going to continue to contribute to that, because rates are coming down, the dollar is softening. and central banks, some central banks, Russia, China in particular, maybe India as well, a few frontline states around the war in Ukraine, given the situation in the Middle East, maybe more gold buying by central banks, and also retail and institutional demand piggybacking on that, plus on the softening dollar and the rate cutting cycle. I think you also have to look out further ahead and obviously think about the American election. We're many of us in the market discussing the Trump trade versus the Kamala trade, or Kamala trade, we might say in India. Look, I think the Trump trade further out might be lower growth, somewhat higher inflation than otherwise, and the Kamala trade might be kind of a more reflationary trade, higher growth and somewhat higher inflation. Either way, the Fed would be more likely to be constrained relative to what the market might expect if it were a pure demand-driven cycle with less of a push from potentially fiscal changes or regulatory changes or structural changes driven by the U.S. federal government, right? So a lot to bake in that I think, it's becoming more in the present just because of the time right before the election and the coming change in administration, one way or the other.
Okay, Arnab, so good to have you on the show. Thanks for taking the time out and joining us with your insights on global markets and their movements.
If you like this video, then like, share and subscribe to ET Now.